there. In light of the meltdown that we saw in the stock market in March, I wanted to take a moment to discuss another way to look at your retirement savings that may help you get through this and future temporary downturns. So while we've seen a nice rebound in stock prices from the March lows, there's really no telling if we're out of the woods yet. And if the downturn does continue, what I'm about to share with you will hopefully help you look at the bigger picture, allowing you to stick with your long-term plan through these various ups and downs. So let's start with the fact that in the simplest of terms, most retirees have two components in their investment portfolio. You have your risk assets or your stocks, and you have your safer assets, bonds and your cash. And I think it's important to remember that as you see the headlines about what stock prices are doing, that most retirees don't have 100% of their savings invested in stocks. Depending on the retiree's own comfort with risk and their own retirement income needs, the amount that they'll have in risk assets and safe will vary. And a common mix between stocks and bonds for a retiree is a 60-40 allocation, 60% in stocks and 40% in bonds. And while stocks get most of the attention, bonds play an incredibly important role in the portfolio, and they're there for three reasons. One is to dampen the volatility of stocks. Bond prices are less volatile, therefore they bring down the overall volatility of the portfolio. Number two, bonds, which tend to hold their value when stock prices fall, can be used to rebalance and buy more stocks. And number three, provide income for retirees, not only through interest and dividends, but also during times when stock prices are down. So I want to focus on that last role of bonds. Going back to that typical 60-40 mix, if you have 40% of your retirement savings invested in bonds, and you're withdrawing 4 to 5% of your portfolio each year, that means you have 8 to 12 years of income needs not invested in stocks. So think about that. Investors are conditioned because of the financial press to think short term, but you must think long term if you're going to be a stock investor. And the cushion provided by bonds should allow you to stay invested in stocks through the different market cycles. 8 to 12 years should give you and your stock portion of the portfolio time to recover before you're in a position that you have to sell stocks. How do we know 8 to 12 years is enough? Well, we don't. But on average, after a bear market, which is measured by a 20% decline or more, it takes about 3 years for stock prices to recover. And that's on average. After the 20% decline in the fourth quarter of 2018, it took less than 4 months to recover. And during the financial crisis of 08-09, where stock prices fell by over 50%, it took 3 years to get back to the October 2007 all-time highs. So 8 to 12 years of draws doesn't guarantee anything. However, the odds are in your favor that at least parts of your diversified stock portfolio will have recovered in that time. And so I found that by breaking down the portfolio into the two different components and sharing with retirees how many years of income they have not in the stock market has allowed them to stay patient and disciplined during temporary periods where stock prices are down. So I hope this message helps you as we continue to get through this current challenging period. If you're looking for some guidance and some support, please don't hesitate to reach out. Thanks.